Ladies and gentlemen, good day and welcome to Tata Elxsi Limited Q3 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Diwakar Pingle from Christensen Advisory. Thank you, and over to you, Mr. Pingle.
Thank you very much, Nirav. Good afternoon to all the participants on the call. Good morning if you're logging in from the western side. Before we proceed to the call, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties and other factors. It must be viewed in conjunction with our business risks that could cause further results, performance or achievements to differ significantly from what is expressed or implied by such forward-looking statements. To take us through the results and answer your questions today, we have the senior management of Tata Elxsi, represented by Mr. Manoj Raghavan, Managing Director and CEO, Nitin Pai, Chief Marketing and Chief Strategy Officer, Gaurav Bajaj, Chief Financial Officer, and G. Vaidyanathan, Chief Investor Relations Officer. We will start the call with a brief overview of the past quarter by Mr. Raghavan, followed by Q&A session. We would appreciate your cooperation restricting yourself to 2 questions to allow participants an opportunity to interact. If you do have any further questions, you may join the queue and we'd be happy to respond to them if time permits. Having said that, I'd like to hand over the call to Mr. Manoj Raghavan. Over to you, Manoj.
Thank you, Diwakar. Good afternoon, everyone. Thank you for joining us today for the Q3 earnings call. At the outset, let me wish you and your families a safe, healthy, and a very, happy New Year to you. I'm pleased to report that we have delivered another quarter of consistent, strong growth. Our revenues from operations for the quarter gone by was rupees 635.4 crores, registering a growth of 6.7% quarter-on-quarter and 33.2% year-on-year. The growth was almost entirely volume-led, reflecting in our constant currency revenue growth of 6.5% quarter-on-quarter and 32.7% year-on-year. On the bottom line, we have delivered another quarter of industry-leading performance. Our PBT grew by 17.1% Q-on-Q and 36.9% year-on-year to 200.3 crores. And our company's net profits for the quarter stood at 151 crores, reporting a growth of 20.4% quarter-on-quarter and 43.5% year-on-year. We have crossed the 200 crore PBT and 150 crore PAT milestones for the first time in our history. The company's growth continues to be powered by our largest division, which is the Embedded Product Design Division, EPD. EPD grew by 9.6% quarter-on-quarter and 35.4% year-on-year in constant currency terms. And if you note, I think this is the second quarter that we are showing almost a 10% quarter-on-quarter growth for EPD. Within EPD, the growth was broad-based across verticals. The transportation business posted a third quarter strong growth of 9.7% quarter-on-quarter and 30.9% year-on-year. Media and communication delivered another quarter of consistent growth with 6.5% quarter-on-quarter and 31.1% year-on-year growth respectively. Healthcare continues to be to grow faster than the rest and posted a growth of 22% quarter-on-quarter and 73.4% year-on-year. As you would have seen in our fact sheets, we continue to add new marquee logos to our customer base and win new strategic deals across key growth areas in all these 3 verticals. We are focusing on building a base of customers in each verticals and segments that can drive consistent growth for us. You will find this reflected in our overall performance across industry and regions beyond the top 10 customers. Our design-led offerings are powering differentiations and deal wins for us with customers and provide a force multiplier with downstream development integration. This also helps us improve margins as we increase the overall composition of software work in the design digital deals. In the last earnings call, I had mentioned an existing top 10 customer where a large design digital deal was put on hold, which affected Q2 and the full Q3 numbers for our industrial design business. The IDV business posted a growth of 61.7% on a year-to-date basis, even with this impact. So we are confident that we will resume this project in the coming quarters. We have been steadily adding our talent base all through last year and in the last 3 quarters with laterals as well as fresher hiring. In Q2, we added almost 500 fresh engineers, while we added about 150 fresh engineers in Q3. We are selective in fresh engineer hiring, and we will invest further in bringing in a large number of fresh engineers over the next 3 quarters. I'm especially delighted with the industry recognitions, both from analysts as well as the awards we are winning for innovation and technology. The Safety Center for Tata Steel uses augmented and virtual reality to deliver experiential safety training to 45,000 workers. For the first time, this is done anywhere in the world. The Video Tech Award for the most innovative OTT technology of the year was won against some of the leading product companies across the world in the OTT. Again, underlines our product and solution-led capabilities. In summary, I would say it has been an excellent Q3 with superior top-line, bottom-line performance that was supported by industry-leading operational excellence and talent retention. We continue to execute strongly on all our key strategies, driving growth across our 3 primary industry verticals and regions, building our software and digital platform engineering, product engineering capabilities. We are also entering the 4th quarter with a strong order book and a healthy deal pipeline across our key markets and industries. With that, I would hand over for the Q&A session. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Bharat Sheth from Quest Investment Advisors. Please go ahead.
Hi, Akwan and Nitin. Congratulations on an excellent performance. Hello?
Yes, Mr. Sheth. Please go ahead.
So, Akwan, since FY2021 as well as in these 2 quarters, we are talking of everything. Our growth is volume-led growth. So to understand what is driving our margin, that one lever you say was because of this designing led. But what are the other levers that is helping us? Because and when we are doing more of advanced work or advanced technology, so are we getting some kind of a price increase or not? If you can give some color on that part.
So yeah, Gaurav, you want to go ahead?
Yeah, sure. Hi, Bharat, this is Gaurav. So I will take that, and maybe Nitin and Manoj can add to that. See, when it comes to the margin, there are a few things that is very important to us, and we have definitely been always focusing on this. I think the first and foremost, as you also rightly said, is the business growth and the consistent business growth. Okay, and if you see that all our business verticals are doing really well, and for the past few quarters we have given at the overall company level very sustained and healthy quarter-on-quarter and YOY growth. So of course those scale and economies always helps to for your margin and bottom line expansion. And the second, I think what we prioritize and strategize at the start of this year and 2 years back is the quality of the revenue of our earnings. Okay, so we always strategize that we want to prioritize the value of the offering and the better margin deals, and we have been signing few sizable deals and with a multi-year contract, and these are at the terms where we feel very satisfied and happy, and those strategies are really working for us. And so that also kind of add to the better margin profile at the company level. And the third probably is on the cost side, which is your operating leverage and arbitrage. So our internal focus always been the disciplined execution and also the operational efficiency. So if you see our utilization, we have been our utilization has been at all-time high. Earlier we used to be in the band of 73 to 75. Now that utilization is almost 80% up. It's almost 83%. Employee pyramid is the other factor where we're able to achieve certain kind of leverage. And then the last probably is the offshore and on-site arbitrage. We always been offshore centric approach, and our customer also always accepted that. But during these pandemic times, it also further cemented that kind of approach with the customer. So that is also kind of helping us. Earlier it was pre-pandemic level, our on-site mix was about 36 odd percent. Now it is almost 23-24. So our offshore revenue mix has improved in the overall business, which is helping our margins. So probably it's a combination of both top line growth, quality of earning, and operational leverage and arbitrage.
Fair point, Raghavan. But if one really look at, we are reaching almost a full kind of a operating leverage that we are enjoying, and now we have to keep on adding a lateral. And if volume will continue strategize, I understand higher margin. But are we getting some better pricing, or how long this kind of a trend will continue? So on the margin trajectory side, if just get, not in 1 quarter or 2 quarter or medium term perspective, if you can give some more color.
So Bharat, see, we don't make any forward-looking statements or margins.
Directionally, Gaurav.
But having said that, see, we believe and we are quite confident we will continue to deliver one of the industry-leading margins and better to do on most of the parameters. But as you know that in the current scenario and situation, everyone in the industry is kind of benefited from some kind of suppressed SG&A and some discretionary spend. We believe that once things gets open up, so some of that will come back. But we don't know. Of course, that will not be immediate, but that would always be over the period. And we believe that it will never be at the 100% level of the pre-pandemic level. It would be some percentage of it, but at today it would be very difficult to say that when, how much it will come back. But on the other side, if you see with our growth, and we believe that with that our overall pipeline and funnel and the robustness of the demand for this industry, I think the growth will always be there. And with our other operating levers, along with the growth, I think with execution strategies and all those things, we will continue to drive and offset some of those parameters. But we have set ourselves some aspiration margin band, and we are quite confident that I think we will continue to deliver one of the better margins of the industry.
Okay, thanks for detailed explanation, and I'll join back in a queue. If I have a question, I'll come back.
Thank you.
Thank you very much. The next question is from the line of Hiren Vail from Alchemy Capital. Please go ahead.
Hi, Manoj and Nitin. Congratulations on fantastic execution quarter after quarter.
Thank you, Hiren.
My question is that you had mentioned that in the transportation vertical, you're seeing growth back, and you also had initiatives of essentially tapping into other adjacencies like off-road, railways. Could you tell us if you've been able to make any headway and what kind of progress you're seeing in the traditional transportation that we are already very strong in? That's question one. Second is, given the fact that skill sets in this area are still relatively few, are you able to get a pricing uptick on the services that you are delivering with the customers?
Sure. So on our transportation business, if you look at it, primarily a lot of our business used to come from passenger car vehicles. But over the last, I would say, 6 to 8 quarters, we have diversified our revenue profile to include commercial vehicles as well as off-road, farm equipment and the rail segments. So it's been a steady progress. We won some good deals on the commercial vehicle space in the last quarter, and that's really helped us grow this piece of revenue. Our rail business is also growing steadily. I would say I would say our focus is, over the next 3 years that 20% of our revenues in the transportation business should come from these adjacencies that we called out, right? And we are working towards that, so I don't see any concerns there, and I believe we'll be able to achieve our objectives there. Skill sets, as you rightly said, there is a huge pressure on skill sets. These are not run-of-the-mill skill sets. You can't use fresh engineers here. You need experienced people. So all of that is applicable, and yes, we have been able to negotiate better terms with customers. So it definitely also helps us in our overall business growth.
And just one last question. Also, I think this year, as this quarter as well, your healthcare vertical has grown very well. Do you believe that this vertical will lead in terms of Q-on-Q growth even going forward, considering the base is still small?
Yeah, base is small, but again, the problem with some of these smaller businesses is that you can always have one bad quarter here and there, right? So while I would really want to say that yes, this growth is going to be indefinite, but I can't predict the future, right? Having said that, I think we have been both quarter on quarter and year on year, we have been having a pretty decent growth in the healthcare business. And our long-term, 3-year roadmap that we put forward talks about a 40-40-20 ratio, right, between automotive, media and communication, and the healthcare business. So we are moving towards that direction. If you look at the fact sheet that we laid out, we are moving towards that direction. And I would really focus on the I think last year is when we laid out, so we are 1 year into that, and the next 2 years we hope that we will achieve this ratio 40-40-20. So I would really focus on that and not what happens quarter on quarter and so on. So I think we're moving in that direction. I'm pretty confident that we will achieve our objectives over the next 2 years. Thank you.
Yeah, and just one last question from me, which I've asked before, and I'm sure many shareholders would want to know is, what do we intend to do with the cash that is now sitting in the balance sheet? I know you mentioned before that you would look at some acquisitions, or if you would look to distribute that cash to the shareholders in form of higher dividends or so on and so forth.
Both options are available, right? There are discussions happening regarding M&As and acquisitions and so on. So we would definitely want to have some cash available to really do an inorganic acquisition. Having said that, I think we will be having those discussions in the next board meeting regarding payback to investors and dividends and so on. So essentially, yes, both options are available, and we will take those decisions in the next board meeting.
Okay, thanks. Congratulations again, and best of luck.
Thanks for that.
Thank you. The next question is from the line of Aditya Ahluwalia from Invesco. Please go ahead.
Hi. Thanks a lot for the opportunity. I think my first question would be just some outlook on the sustainability of this growth that we've shown last year. You think it's possible to continue at these numbers next year and the year after?
Sustainability, if you look at it, you just need to go back 8 quarters and see, right, how the growth trajectory has been. So we have shown that sustainability over 8 quarters. So will we be able to show the same growth the next 8 quarters? I believe we are pretty confident about it. But you never know how the industry outlook would change and so on, right? But as a management team, we are pretty confident, we're pretty bullish. Whatever we laid out as a strategy 2-3 years ago, and we have followed that strategy, and we have communicated that multiple times to investors. And whatever performance you're seeing are down to those strategies that we laid out, right? Including adjacencies, including in focus of medical business, including the sort of growth in the US market and so on. So we laid out certain themes and so on, and we have follow through on all of those things. And I'm pretty happy that we have been bang on, whatever strategies that we laid out. We have followed it, and we are seeing those results, right now. So, and then we have a great set of customers, good logos to have, and quite a lot of them are underpenetrated. There is a lot more, lot more that we can do with some of these key logos that we have. So I would be pretty bullish about sustaining this growth moving forward.
Thank you very much. That's very helpful. So you said you have very good customers, and we noticed that your top customer has been growing pretty well, and the concentration of the share of the top customer has also been increasing in the last couple of quarters. So can you tell us what is driving this strong growth in the top customer, and is it JLR or any sense in that?
I think it's a lot to do with deeper mining and focus, and actually some of the large deals that we have been able to win over the last 2-3 quarters, right? And I would say some of the growth that we're seeing is the ramp ups of the deals that we have won over 2-3 quarters ago, right? So yeah, we're pretty happy with where we are.
Right. So the outlook is strong on JLR front as well, is it?
Sorry, I couldn't hear the question. What is it about JLR?
The growth outlook on JLR is also the same as the rest of the company. It will perform in line.
Yeah, I think JLR is also, JLR's business over the last couple of quarters have also, looking up. I think they have been affected by the semiconductor crisis, but I think they are on a very strong wicket. And in the next 2 quarters, once the crisis, it comes out of this semiconductor crisis, JLR will definitely, be much more profitable. They'll have a lot more cash on hand, and we really hope that will really help us also in terms of more outsourcing budgets and more R&D work and so on. So we're pretty bullish there.
Thanks a lot. Thanks. Just are the deal structures similar as far as the life cycles of the project, or has that changed in these times?
No, so what we have been seeing is, over the last 6 to 8 quarters is that we have become more and more strategic with many of our customers. We have been able to strike long-term deals with many of these customers and actually provide value to these customers, right? So I think there's definitely been a shift from a one-off project basis to a more long-term sustainable win-win relationship from both parties. So that's we continue to see that.
Sorry to interrupt you, Mr. Aditya. I'll request you to come back in the question queue for a follow-up question. A request to all the participants, please restrict to 2 questions per participant. If time permit, please come back in the question queue for a follow-up question. The next question is from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Thank you for taking my question. Am I audible?
Yes, sir.
Yes.
Congratulations on a great quarter and consistency performance. So my question relates to the previous participant as well. As far as sustainability is concerned. So if you could, it would be great if you could give us your opinion on what percentage or component of our revenues are related to discretionary spend by clients, and what indicators should one follow in case things turn around from here, or even become better? What indicators should one follow for demand environment, basically?
Can you repeat that question on what do you mean by indicators? I mean, what is that question?
What macro indicators or should we look at to gauge how demand is translating into our revenues, basically?
I think you should just focus on how the world is moving towards more and more digital spend, right? That will give a good indication, especially both on our on all the 3 verticals. Increasingly, what we see is a lot of our business comes from integrating design and digital put together, right? and that is a theme that we have been focusing on. So whether it's our media and communication business, wherein a lot of our new projects or new customers have been focused on the digital part of the business, right? And even in the medical business, if you look at it, how does digital technologies, cloud, DevOps, agile, all of this affect the various industry verticals, right? And we have bang on. We are right there in all this transformation that is happening, across the industry verticals. Even in the automotive industry, if you look at it, a lot of the new deals that we're winning are on digital spend, on connected car, on cyber security. A number of those trends that are really changing the way the industry is operating in. So I think that is a sort of a hint to you in terms of where we are making our money.
Sure. That was all from my side. Thank you and best of luck for the future.
Thank you.
Thank you. The next question is from the line of Naveen Bothra, individual investor. Please go ahead.
Yeah. Congratulations, sir, for the stellar set of performance and continuing the last 10 quarters, more than 5% quarter-on-quarter sequential growth in this quarter also. And as you spoke about the confident that coming 8 to 10 quarters will be almost similar to like that. So congratulations for great set of performance. My question is, sir, regarding the IDV division. We have performed quite better compared to last year and year. But when we see the numbers, quarter one was 78 crores, and after that it has come to 56 crore around. So if you can throw more light on the IDV division going ahead and what are the prospects there. And second question is regarding our top customer is still from the media sector, or again JLR has come back to the top slot.
Sure. So yes, IDV is a smaller business that we have, and IDV has seen some amount of yo-yo, in their quarter-on-quarter revenues and so on, right? I think it's largely to do with one large customer where we've completed a particular work, and the next set of activities was supposed to happen in Q3, but that project did not get started, right? But at the same time, we are hopeful that we will kickstart that in Q4 or in Q1 of next year. So again, that is one of the customers in the top 6 to 10 bracket that we have, right? And that's a pretty sizable engagement for IDV. So I think it's a temporary issue, and as you rightly pointed out, if you look at the quarterly numbers, sometimes it's quarter-on-quarter numbers, sometimes it is misleading because it's a small business, and even one significant deal moving here or there will cause your numbers to look very different, right? But as you rightly pointed out, from a year-on-year basis, if you look at the full year basis, IDV would definitely grow 60-70% over the last year's performance. So that is the sort of confidence that we have, and which is very positive for us. But however, we get your point. We are working on strategies wherein we are building a set of good customer base for IDV, so that we can consistently grow that business and consistently be able to report numbers there, right? In line with what we have done in EPD. Having said that, the real issue is also that the IDV capabilities really help the organization, right? Not just IDV alone. It helps our customers in EPD also. So many a time it's a combined deal between EPD and IDV and EPD. Sometimes it's very difficult to split the revenues between EPD and IDV and so on. So from an organization's perspective, IDV has definitely contributed in the growth that EPD has shown. Though the numbers IDV shows a smaller number and maybe even a quarter-on-quarter degrowth, but actually from organization's perspective, the capabilities that we have in IDV has actually helped us to win larger deals in EPD and also to get better margins and better pricing also because of the capabilities that IDV bring in, right? So IDV is very critical, and we will definitely see how we can stabilize the IDV revenues, moving forward. And also, I think last time we discussed, we are also contemplating that IDV is also done the service line, right? So the way we represent EPD, IDV, and so on, we may have to relook it, and so that it's more aligned with the industry verticals that we are operating in, not the service line. So that's something that we are working on. Regarding the top customer, yes, it is still the media and communication vertical customer, and then we're pretty happy that we've been really growing those revenues, winning large deals, and really winning market share from competition. JLR also continues to grow. So I think these are very positive for us.
Okay. And one last question from me. If you can say about the IPR and licensing revenues, are still below the 5% or crossed the 5%? If you can share.
No, it is still below 5%. It is still below 5%. Again, the products or the frameworks that we have are standalone, even though the revenues are not very significant. But from a positioning perspective, from right to win perspective, these are all important for us to invest on and really build these products and these solutions to help us win large deals and beat competition. So while the standalone revenues may still not be significant, but definitely to build credibility in the space, we need to continue to invest in building these products and IP, and we'll continue to do that.
Okay. Thank you very much, sir. Congratulations once again. Great set of numbers.
Thank you.
Thank you. The next question is from the line of Karan from Jeta Global. Please go ahead.
Yeah, hi. Can you hear me?
Yes.
Okay, great. So I wanted to just dig into the win you cited in your fact sheet with the new age OEM. Perhaps you can just give us a sense for the size of the deal and the various components of the deal. That's the first question. The second question, which is somewhat related, is it appears to be a trend where your peers are starting to win business from not just auto companies, but also auto semiconductor companies such as Renesas or Qualcomm, or at least they're in trials with those companies. I'd just be curious as to whether you would be exploring the same opportunity. And then the last question I had is just the shortage. Of course, Toyota announced recently or last week that it's still being impacted by the auto shortage. So you mentioned you think it is a 1 or 2 quarter problem, and then after that we're sort of in the clear. Just want to push on that and ask how much visibility there is there, where if that slips, do we then see a slowdown in the transportation segment?
Sure. So I will ask Nitin to take the first part. I will answer the second part. Sure. Yes, we work with the semiconductor companies. For example, we have been working with some of these names for the last 20 years. So auto semiconductor companies is something that we have been working for many years. In fact, some of them are large customers of ours. And though we don't publicly announce these large deals, but we are very well entrenched with some of these auto semicon companies. And in fact, we will be making some press releases so that you're aware of the type of activities that we do with some of these companies, right? So that's very much a part of our our focus. Regarding the last part of your question, I think you talked about the semiconductor shortage and so on. Yes, I strongly believe that it's a couple of quarters away. In fact, even in this quarter, I suppose companies like JLR and so on will show much better improvement in their sales and so on, because the shortage is easing down. So we really hope that will really help us translate into more business for us. So we're pretty bullish there. Nitin, if you could take the first part.
Yeah, thanks, Manoj. In fact, I just wanted to add to what Manoj said, that unfortunately we don't have much to announce on the semiconductor side because we've been working with them for long. So there's nothing new about it to talk about. But coming back to that new age EV OEM, we have initiated an engagement on core platform software development. Now, when you talk of platform software, that essentially forms the architecture hub for everything on top, whether it's electric, whether it's autonomous, whether it's connected. So this is the platform architecture itself. So while we made a small start, we believe that it's the beginnings of something that can be much larger.
Thank you.
Thanks.
Thank you. The next question is from the line of Pranav Thakkar, individual investor. Please go ahead.
Yeah, thank you for the opportunity and congratulations.
Karan, sorry to interrupt you. You're sounding slightly distant. May I request you to speak a little louder?
Am I audible now?
Slightly.
Yes, you are.
Hello. Yeah. Congratulations on great set of number. The quarterly profit of the yearly profit of 2016 is now quarterly profit of our company. So very happy and great going. My question is with reference to the design link incentive initiated by the central government, and wherein certain percentage of revenue of semiconductor chip being designed will be, the company who designs will be eligible for it. So is Tata Elxsi is eyeing to get that DLI scheme? And another is in reference to the number of count of EV players we are associated, and also if you can share the number of count semiconductors companies we are providing services for. Thank you.
Yeah, well, the ELI scheme, I think, is something that we are evaluating, and as you know, we definitely do a lot of chip design sort of activities, but at this point of time, we really don't have anything else to report on that, right? We do work with about close to 4 semiconductor companies in this space. And what is the other question, Nitin? Something.
Out of top 10 EV manufacturers we are associated with, because it's like a follow-up or clarification given before 2 quarters.
How many EV companies that we've associated with?
Yeah. So Manoj, I think that's difficult to call out, because the question is, when you say EV, who? Because all the conventional car companies also make EVs today, and then you have a whole set of new age OEMs who don't have, except for barring one, maybe don't either have volumes or even production commenced in most cases, right? So I don't think that's a fair count. We would not want to call out that number right now. All I can say is that we work with a very, very good number of traditional OEMs who are pivoting very strongly to EV, and a whole set of new age OEMs who are born EV.
Okay. Thank you so much.
Thank you.
Thank you. The next question is from the line of Dev from Invest Yadanya. Please go ahead.
Yeah, good afternoon. Can you hear me?
Yes, you can.
Yeah. So congratulations on a good set of numbers. My question was, can you tell me the total contract value of this year's quarter?
Usually we don't disclose these numbers, so I'm sorry, we'll not be able to share that details with you.
Okay. And can you tell me about this ER&D space in general? And what is the future outlook and all?
Nitin, you want to address that, the future?
Sure,
future of ER&D.
Let me take that. Yeah, so I think as far as digital spend goes, as far as budgets outlaid by companies go, I think ER&D is seeing the largest growth among all of the spends that are possible from companies or enterprises, right? So you have typically IT spends for run management, you have application development spends, you have infrastructure spends, and you have ER&D spend. So within these buckets, while ER&D has traditionally been the smallest piece, it's now the fastest growing, right? And that is simply because I think in general what is happening with companies is that the context of connected and intelligent products and services which can be monetized based on the kind of data that you have and the connectivity and the relationship you have with customers, irrespective of which sector you operate in, whether you're a car company, whether you're a media, tech, telecom company, whether you're a medical device company, the fact that you're connected to consumers or customers and you're able to deliver more services to them because of that connectivity and connection, and that data that you get from them allows you to enhance the value of what you're delivering, I think is the strongest trend for what brands and products and companies will do for the future. So I think, as in a simple word, that is what is driving this industry. And therefore, the space that we are in, which is software-centric, design-led, I think forms the crux of what we believe value will be delivered on the basis of. So I'm hoping that kind of answers your question with no simple answer or a small answer to your question.
Yes, sir. And any growth growth rate, number, if you can tell me.
Yeah. So again, I think like Manoj said, we don't offer a guidance on future growth. I think the closest you get to is Manoj's statements on our past performance over the last many quarters, and the fact that we don't see any significant reason for why that should not continue without any significant external factors changing.
Thank you. We have a request to come back in the question queue for a follow-up question. The next question is from the line of Pradeep Gokhale from ITI Mutual Fund. Please go ahead.
Hello, sir. Thanks for this opportunity and excellent congratulations on excellent numbers. My question is regarding operating margins. If you look at last year or even that is the December 20 quarter or the quarter gone by, the margin range was around 30-odd%, and I believe the COVID-related cost savings and all would have been there in those quarters. So in your remarks you said the large growth is largely volume led. So what explains the almost 2+% improvement in operating margin versus December 20 or September 21 quarter that we see? Yeah.
I think that has been answered by Gaurav in the first question that was raised. Maybe Gaurav, you can repeat it once again.
Yeah, sure. So I think that was the first one which we took. So I think what we mentioned that it has always been combination of, on the top line and the bottom line, what strategies and what we are doing. It will be a combination of, the growth and the sustainable growth and versus the quality of the revenue. And I think the focus that we have, this year we have been focusing and prioritizing is the, better margin deals and also prioritizing the value offering to the customers. So that is also helping in terms of building the, better top line compared to, both top line and also the bottom line compared to what has been, reported in the past quarters in the last years. And also the other factor is on the operating leverage and arbitrage, I think in terms of the utilization factor improvement, employee pyramid, and the arbitrage that we are getting from the offshore mix in the overall revenue. So all those factors and the parameters is contributing to, the better margins. And of course, you mentioned yourself that, certain SG&A expenses and discretionary expenses, which is little bit suppressed due to the lockdown and pandemic, that is also helping the cause of the margins currently.
Yeah, but those would have been band like similar, right? In December 20 quarter also, it was post-COVID or last quarter also. Those would not be those would be largely be same, right?
That's right, Pradeep. So this is Nitin here. So I think while on the travel costs and typical SG&A, we would have somewhat a similar situation 2-3 quarters before and now. I think the answer really lies in the other factors, right? On-site offshore ratios have continued to lever towards offshore. That definitely delivers better margins. Our utilization has gone up by a few points, and all you need is a few percentage points of increase to give you that little boost. We have improved The quality of revenues in terms of the kind of work that you're doing, we continue to improve that. We're not saying that it's not improved. We've continued to improve that. We continue to realize better margins from the kind of design digital deals that we're signing, right? So it's really
the business volume is also increased, right? So contribution of SG&A to that extent also will go down.
Okay. Yeah. Okay. Got it. Thanks.
Thank you. The next question is from the line of Abhishek from Nomura. Please go ahead.
Thank you for the opportunity. Congrats to the management for a good performance. Sir, I'm looking at the last slide of your presentation, where I see that your fixed price projects have been rising consistently, and now they're almost 50% of the total revenue. Can I say that this also has been a factor behind your improving margin trends? And over a longer period of time, do you think there's further scope for you to make your revenue stream more fixed price, annuity related business, or the nature of business means that might be the kind of mix will work in future as well? Any color here will be useful, sir. Thank you.
You want me to take that, Manoj?
No, I'll handle that. So yes, fixed price over a period of time has been going up, and you should understand that fixed price means we take a lot more risk in terms of ownership and delivering value to our customers, right? And so to that extent, I think our internal systems, internal processes have really helped us to be able to deliver value to our customers. At the same time, ensuring that from Tata Elxsi's perspective, we don't bleed or we don't get into such deals wherein profitability gets a hit, right? So having more fixed price essentially means that you need to have very, very strong internal controls, your entire estimation capabilities, your project management capabilities, all of that comes to fore. And I'm pretty happy and proud to say that, look, we have built one of the very, very strong internal capabilities to really be able to focus on project management and delivery excellence, right? So to that extent, yes, I would say the fixed price, the fact that fixed price projects have increased have also helped to an extent with the margins. But again, it's a double-edged sword. If we take some wrong deals and if you take full ownership and take it in a fixed price and so on, and if we underestimate or if the complexity of the program goes up, then rather than what we had estimated, then there's also a possibility of losing money in those deals. You have to be careful. I'm pretty happy with the current situation. Idea is not really to push more and more fixed bid and so on, but eventually we will have more fixed bid as we mature in our service offerings and our overall confidence. We will move towards the direction.
Sure, that's helpful. So over a longer term, do you think this number can even go up from here towards 55-60% in line with the IT services companies who also have ER&D businesses? Do we see a scope of increasing toward that number?
It is possible, but I wouldn't want to indicate any time frame or anything, right? I think as an industry matures, and you should understand that as compared to IT deals and so on, which is typically maintenance and so on, everything is known, right? Most of the ER&D, at least the projects that we do, are fresh, new developments, mostly new technologies, new areas. So like any product company venturing into any new development, there is a lot of risk in terms of whether the product will come out on time, on schedule, with the quality parameters, all of that taken care of, right? So to that extent, I would caution you to really, we will not move there in a hurry, is what I want to say.
Got it. This is helpful. And so any comments on, attrition, it has jumped up, for us, in line with how the industry is also behaving. But do you think we are close to the peak of attrition for ourselves and should possibly stabilize in the coming quarters at around, this 18-20% mark?
Yeah, I do seriously hope that, we are doing a number of things to control attrition. There's a lot of initiatives, with our employees and a lot of internal programs that we are doing to really build a better place for our employees, right? So no doubt about it, this is taken very, very seriously. We are also looking at, so for example, from a salary hike perspective also, I think 2 years ago, we did a salary hike in the October quarter. And then in about 9 months last year, in July, we did a salary hike. In 6 months from there, in January, we're proposing a salary hike. So essentially what I'm saying is, look, over the last 15 months, we will be hiking a salary 3 times. So there are a number of things that we are doing. So I think we should be able to control this.
Thank you. Abhishek, I'll request you to come back in the question queue. The next question is from the line of Mithun Aswad from Kiva Advisors. Please go ahead. Mithun, we are unable to hear you.
Hear me now?
Yes.
Hello?
Yes, sir.
Yeah, go on. I think we can hear you. Sorry, I think we have again lost you.
Mithun, may I request you to come back in the question queue? Thank you. The next question is from the line of Kshitij Saraf from Tun Investments. Please go ahead.
Hi, thank you for taking my question. It's around how deeper we plan to go in our 3 verticals, auto, media, and healthcare. You mentioned a 40-40-20 split. So how do you see the total addressable markets for these verticals growing for Tata Elxsi, and where do you plan to go deeper? Specifically, if you could throw some light there, it would be very helpful.
Nitin, you want to address that?
Right. Yeah, so thanks, Manoj. Kshitij, I think the way we see it is that on one hand, the markets that we have picked are very, very large by themselves, right? So automotive obviously is among the largest ER&D markets ever, among any segment that you pick up. Media and telecom follows closely. The healthcare market in terms of medical devices is far smaller, but when you look at the expanded definition that we have, which is of digital health and pharma, you're again talking of a fairly significant market, right? So the first thing I want to clarify is that the market sizes are big enough, and we represent only a fraction of that potential market. For us, the way we see it is that we need to drive our growth both in terms of realizing the potential within each of these verticals, but equally also de-risking between any industry cyclicity that we see, right? Because all said and done, every industry has a cycle, and you will see that cycle turning up and down over a period of time. So we also want to make sure that we are not single industry focused, we are not completely dependent on the cyclicity of a single industry. So to that extent, the ratio that we called out as a strategy a few quarters back, which is to drive a 40-40-20 ratio, looks at both factors. Looks at 1, the market and the market size. 2, looks at the opportunity in terms of technology and where the industry cycles are. And 3, looks at risk and balancing out of risk. So in that sense, I would call it out as a strategy that we have taken rather than a reflection of the potential of each of the markets. Because you could choose to take just one market and get all your money from it. Nothing stops us.
Got it. Thank you. That's very helpful. And just one more thing. So in the past couple of quarters, we've had an announcement on an ad tech partnership, and we have the partnership with Green Hill as well. So from a partnership standpoint, could you also throw some light on the plan ahead? Where are the areas that you plan to partner, and for what specific areas? Just any insight there would be really helpful.
Sure. Manoj, if it's okay, shall I take that?
Yeah. Go ahead. Yeah.
Okay. So the way we look at partnerships really are twofold, right? 1 is acquisition of technology, and 2 is go-to-market. So from an acquisition of technology, we already have a large number of partnerships that are already at play, which allow us to understand, absorb, and prepare ourselves on what is coming up. And therefore, there are partnerships that we have with very leading semiconductor companies that are inventing chips and software and applications for certain areas like 5G and autonomous cars and so on. We equally have partnerships with companies that are building components of software that go into any of the areas that we are investing in, right? In media and telecom, it could be ad tech. In automotive, it could again be software that goes into autonomous vehicles or electric vehicles and so on and so forth. So these are all technology-related partnerships that allow us to make sure that we are ready. We are the first off the block in terms of what our customers are exploring and wanting to build on. The second kind of partnerships are where we not only acquire technology, but we include them in our solutions and we go to market together. Now, those are a little more fewer in nature, but they are also more strategic. So when you look at areas like OTT, when you look at areas like AdTech, when you look at areas like EV, you will see that we'll be announcing a lot more of these partnerships where two companies come together, build solutions together, and then take it to market together. And the idea is, of course, to increase the volume that we have accessible to us in terms of customers, but also make it easier for customers to select us, right, in terms of time to market, in terms of cost, in terms of innovation, the ability to improve our right to win. So we have clearly laid out plans on both fronts. Technology partnerships are many, and we already have them in play. Go-to-market partnerships are far fewer. We also have to be careful, right, because that impacts our brand too. So when we choose a partner and we go together, we have to make absolutely sure that we are selecting the right partner as much as the other party is selecting us, and that it does not impact our reputation in the long term. So you'll find that we will make announcements as we go along, and you'll find that they're all aligned to where we believe the world is going.
Thank you. The next question is from the line of Amit, individual investor. Please go ahead.
Hi Nitin. Hi Manoj. Congratulations on a fantastic set of numbers. My question was pertaining to the non-linearity between the revenues and the costs this quarter, where the revenues have grown faster than the costs, and our employee growth is also 5% QOQ. Is this something that is sustainable? Is this this non-linearity, or this is a kind of a one-off?
Yeah, I think we've improved on our billability and ratios and so on. Yes, we definitely would need to add a lot more employees, right, moving forward. And so I would say I think non-linearity that you talked about is a combination of multiple factors. Better longer term deals, better pricing, and so on is also a factor there. So that part will continue, but definitely we'll add a lot more employees, right? So it's not that we'll be able to do greater revenues with lesser employees. So we are not at that.
Understood. My second question is we've announced deals in EV, connected vehicles, autonomous vehicles. I just wanted to know what the average length of those contracts would be.
Typically, most of these deals are between 12 to 18 months, some cases 24 months, and so on.
Okay. So, yeah, thank you, and congratulations again for a fantastic quarter.
Thank you.
Thank you. The next question is from the line of Yash from Indira Securities. Please go ahead. Yash, we're unable to hear you. May I request you to unmute your line from your side and go ahead with your question, please? Due to no response, we move on to the next participant. The next question is from the line of Kunjan Chanchan from First Global Securities. Please go ahead.
Hi, sir. Congratulations on the good set of results. My first question is on the follow-up on the margins. If you can throw some light on the vertical-wise margins between auto and media and healthcare.
Hi, this is Gaurav. So we don't report margins at the industry vertical levels. I think as our operating operating metrics we only do at the company level, so we won't be able to disclose the margins at the industry vertical levels. But it's fairly spread across all the verticals, so we
So
don't see
not
any large difference.
not exact numbers, just a rough estimate. Like, is there a huge variance between two verticals, or
think,
all are the same line?
Yeah, I think I've answered this question in earlier calls also, right? Our medical business continues to be, on the higher side. The margins continue to be on the higher side, followed closely by both media and communication and automotive.
Thank you, sir. Thank you for that. And my second question is regarding the attrition rate, or you can say the employee costs. So what are you seeing the trends in the whole industry? This is not for Tata Elxsi only, but across industry. So what are your thoughts regarding that? Can you throw some light on that as well?
Throw light on attrition, you mean?
Yeah. So the attrition rate is higher in this quarter for all the companies. So I just wanted to understand.
I think the fact is that due to the pandemic and so on, many industry segments, right, realize that they need to have a digital play. It's not just in the three verticals that we are working in all other verticals also. Those companies that have had a digital play were still able to continue their operations, were still able to service their customers and deliver value to the customers. So what we're seeing is a lot more of the companies, even the traditional companies, are aggressively getting into the digital play. They want to have a digital play, and what that means is more demand for engineers who can help them, create the digital play, and that is a spiraling effect on the entire industry.
Thank you. The next question is from the line of Kanishka, individual investor. Please go ahead.
Hi, congratulations to each one of you. Fabulous performance. My question, I've got two questions. First, I want to understand. See, there's a marked initiative going in the EV side. So, from Tata Elxsi's point of view, I want to understand that if you let's say consider a car, what percentage of contribution that Tata Elxsi is making in that particular car, which is a ready product as of today, and the technologies which you're working on, and you also mentioned about partnerships. If I see the next 2 years and 3 years where this particular sector matures, from the current percentage content, where do you think you can take it to in a finished product in the next 2 to 3 years?
Yeah, maybe I'll take that. You have to look at it along two dimensions. One is in terms of what is it that goes into a car today, and therefore if you look at it, you have mechanical components including structural materials such as steel, plastics, and then you have electronics and software. Software, of course, is intangible. When you weigh the car, you'll find that there's no weight attached to software, right? But there is a value attached to software.
Yeah, I was talking about value terms. I'm sorry. I was talking from the value terms in terms of the software contribution or the content contribution which Elxsi does in a finished product today, and the technologies that you're working on, where at what percentage traction you want to take it in the next 2 to 3 years when it matures.
Got you. So therefore, if you look at that journey, the first journey is software and electronics increasing as a percentage value in the car itself, and that is an absolutely upward trend all through. So while the total number of car units sold globally are not increasing, what is really increasing is the percentage of sophistication in the vehicle driven by electronics and software. So that directly drives our growth. Part one. Part two is sophistication by itself, which is not doing the same thing that you did the year before and the year before that. So if you look at autonomy, we had absolutely no autonomous features. We had no driver assistance features. You're now starting to see that come not just into high-end cars. You're actually seeing even mid-end and low-end cars starting to talk of ADAS features, right? And we expect that sophistication will continue to accelerate and increase. So if you'll move from level 1 autonomy to level 2, level 3, level 4, level 5, that's one journey. Two is seeing more and more mid-segment, small segment cars starting to deliver features of autonomy. Electric vehicles is a trend by itself, right? So we've always been working on electric vehicles. we believed that it had a long road ahead. It just seems to be pivoting faster. Connected has always been there. We believe that more and more cars will now offer connected services, including infotainment and otherwise. So for us, I think that is the driver. The fact that in general, electronics and software is continuing to increase at a rapid pace. Two, the level of sophistication is increasing in each of these technology trends. Three, there is a larger percolation downward into from premium to mid and lower segments. Right? The last and most important trend is also that a lot more of that software development, a lot more of that innovation is being delivered through software, which otherwise was mechanical, electromechanical, or electronic, is now becoming purely software defined and software delivered. So that again increases the amount of work that we will have to do quarter on quarter, year on year.
Right. Yeah, thanks for that. And my second question is that, so you have like mentioned three verticals: auto, media, and healthcare. I want to understand from you, there is this major shift which is happening in the manufacturing side. So I'm talking about the manufacturing upcycle, where the traditional ways of manufacturing is moving more towards robotics, automation. And like as I see, a car which is more mechanical is moving towards more software driven. Do you see there could be a tremendous amount of opportunity in the manufacturing side globally where Tata Elxsi can actually work on that opportunity? Or maybe you guys have already started to look at it as an adjacency?
Yeah, so that is something that we are both watching and investing in. So that is something that's already underway. And you are right, there is an opportunity there, not in conventional manufacturing, but in transforming manufacturing to a lot more connected and digital. More the industry 4.0 path of automation and connected factories. So we do see an opportunity there, and we are exploring and investing, and yes.
Thank you very much. Ladies and gentlemen, that would be the last question for today. I will now hand the conference over to Mr. Manoj Raghavan for closing comments.
Yeah, so thank you all for taking your time today. You got a good idea about Tata Elxsi and where we stand in this ever-changing market, right? But one thing is pretty clear. We're pretty confident on the capabilities that we have internally as an organization, the sort of the senior leadership that we have to drive the business, and also the great talent pool of engineering team, architects, subject matter experts, and so on. So I'm pretty confident that we have a right winning to really propel our business forward, and I hope that we will get back to you next quarter on a similar terms. Thank you so much.
Thank you very much. On behalf of Tata Elxsi Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.